Okay, thanks Carlos for asking me the question. Just first of all, I just want to make clear that the fund that we manage, including the Silver Autonomy Fund, we have exposure to healthcare, but we are not a healthcare fund. We are well diversified, and I think you're right, it's necessary to be diversified over different sectors. Regarding healthcare, I think it's very heterogeneous, right? You have 4 different subsectors. Biotech, we don't go there. It's very difficult to invest because it's very binary. You know, you can lose all your investments. It's very risky. You need to be a specialist of biotech. Big pharma, this is also, according to us, quite a difficult sector because here you have a lot of regulation, and as an investor, you depend on a pipeline of medicines, and then you have patent issues. So where we focus is on life sciences, the companies giving the tools, producing the tools for production and research, and also on medtech companies that have pricing power and that offer service and products that are really necessary. There were between until the end of 21, until the end of COVID, the performance of those companies were fantastic, phenomenal. There is structural growth because there is a lot of innovation, RNA, gene therapy, biotech, a lot of innovation in cancer, obesity, and so on. So there are very strong dynamics, but very few winners. And so we, as an investor, you need to focus on those winners, those who offer products and services that are absolutely necessary. So from until the end of 21, they did very well. And then after COVID, for the past 3 years, it's been very difficult with some deception because of huge inventories. But the structural growth is there, we think, for the coming years. So now we're at a point where many investors got burned, you know, over the past years and are a bit disappointed. So that's maybe where we start seeing opportunities. But we need to be very cautious with different dynamics. You were talking about regulation in the US, and I think you're totally right. This is not good on the short term, at least for the business, although on the long term, you know, we need innovation, and there will be innovation. There is also maybe the competition emerging from China. So that's why you need to be very selective and very focused. That's a long answer, but it's not an easy question. You know, here, I think somehow it's a very good link with your first question, because what we're aiming at are the no-brainers. You know, the companies where you know they are winners today and they will compound over the long term for the benefit of the shareholders, and where with the less risk as possible. And that's the companies we're looking for. So very high quality stock with strong growth on the long term, no cyclicality, pricing power, super good management. Those are the companies we're looking at, and we are looking to buy those companies at good valuations. You know, it's very seldom that you can have fantastic price, but you can have good valuation. So those are the companies we're looking for, and we think that the best place for long-term, and I insist on that, long-term investors. So sometimes you can have a bit of volatility that creates opportunity, but when you look at our performance, we managed to do 8-10% annualized return with being on the best companies and taking very little risk. So that's what we want to do. And when you have 10, 15, 20% growth, you should find this on your NAV. So of course, maybe you can have much higher return with going into other segments like venture capital, but you will take a much bigger risk as well. Our priority before making money is to make sure that the funds that are invested are protected, and the best way is to invest on the best companies on earth. Thanks, that's a super question. I think right now maybe the healthcare, but it's more, as I said, life science and medtech. It's about 35% of the fund. And here it's really the cream of the crop, really the best of the best. And we are confident with those guys because we see orders picking up, and so we will see it in sales in the next quarters. So that's for the part. But because of what we said before, you need to have diversification. So the fund, Silver Autonomy, but also our other funds, we make sure on the portfolio construction that there is diversification among sectors. So we have some tech, we have some non-discretionary consumption, we have also a few finance company, but once again we want fantastic business, and right now you're right, we saw that for example European banks did very well, but do we really want to buy leverage on the European economy? Because that's what you buy with European banks, and they are I don't say they're not good companies, right? They are good companies, but we really prefer to focus on those non-brainers that we have on the fund that have very high return on capital employed, very strong growth and high barriers to entry. So we are not very exposed to European finance. No, I would say not at all. We have a few industrial company because like Schneider or Legrand, for example, because those guys, they offer a lot of service to make the home environment safer. So that's for the thematic. And they are very good business because they are the world leaders for economy of energy in data centers. So there is a huge needs of energy with the development of IA, and those guys are really the leaders in terms of energy efficiency. So we think, that's a good place to be. You can buy those companies at with reasonable multiples, and they're very well managed. So those are two examples of industrials, and they are part of the sector diversification. Well, I think it's really always the same philosophy: invest in the long term on the best companies on earth and let them compound. That's what we do. Just to follow closely to make sure, there is no change of paradigm. You're right that you do not go against the Fed. That's a mistake. People who try that, generally, they are not very successful. But the fact that hypothetically, right? I don't know what will happen, but hypothetically, we could be, but we couldn't as well. I don't have a strong opinion about that. In an environment where U.S. interest rate go down, I think that will be positive for the stocks, and especially growth stocks. If you remember 2022, those same stocks were really penalized because their valuation multiple decreased because of higher rates. So you will see a lot of outflows from fixed income going to equities, and especially looking for growth stocks. But it's also a discipline to buy those stocks with reasonable valuation. And maybe that's also part of what's been a bit difficult in the few past years for stock pickers, is that we saw a few crazy valuations that have driven the index, and maybe there will be some correction in the future. So we need to keep a very strong discipline on the quality of the business, but on the management, but also on the valuations. I think that's a good question, and thank you for asking it. I think in the portfolio construction, personally, I have no passive investment, but I totally understand that as an investor, as an institution, you have some passive investments, and I don't say that it's not a good investment, right? Personally, I prefer to be invested in companies than in index. What we do, we invest in companies. Second, we have very strong impact process and SRI process that are very well documented, and I think this is very important, especially for institutions. Third, we are an entrepreneurial firm, and so you can call me anytime, weekend and holidays included. I will answer my phone. You can call me in 5 or 10 years, I will still be there answering. And I think this is a very important point. I'm not here to sell something and get a bonus at the end of the year. And I think the problem with our industry is that many times people are too short term. We are very long term because our interests are perfectly aligned. And also we have a philosophy of being more than a simple is in code, right? We are a club of many of our investor institutions, and we discuss, we share the same interests, and sometimes we gather and we can exchange ideas. And I think all those points are very important. The industry will go in two directions. One will be passive investments, low cost, and the other one will be funds that have very strong DNAs, a lot of service, a lot of work behind for the construction of the portfolio and of the SRI, and for example, Silver is SFDR9, and I think that everything that is in between might suffer. I think it's what is important. Thank you for this last question. I think what is important when you invest in equities is to be able to see your investment going down 30% and feeling comfortable to reinvest. And I think here we have a very strong thematic with global leaders that are very well managed, and with a team that's been there for more than 10 years, delivering good performance on the long term, and that will still be there in 10 years. And I think that's part of what we can offer to investors.